Good evening, and it's great to be back again after being away for a little while, and I'm looking forward to providing your Monday night dose of property education. This is Your Money, Your Call, and I have two fabulous regular guests here with me tonight to help me answer all of your questions. But before I introduce them to you, here's your property news for this week, and a CLSA analyst says interest rates in Australia will be less than 1% within 2 years and could even go to zero. Christopher Wood, the Managing Director and Chief Strategist of the Asian-based equity broking and investment firm, made the forecast in an interview with the Australian Financial Review. The AFR notes the most recent Bloomberg Survey of Economics indicates an average interest rate forecast of 2% for the end of the year and the first quarter of 2016. Now, it's reported that Wood told investors to sell US mortgage securities before the subprime disaster. In regard to Australia, he's quoted as saying it's not whether interest rates go up, it's whether Australian interest rates go to zero. And in other news, a Perth-based startup is looking to connect everyday investors with property developers who are seeking capital for their next project. Crowdfund Up is Australia's first real estate crowdfunding platform, and they hope to tap into the global market. Real estate developer Megara will be the first real estate developer in Australia to participate in the platform's developer partner program. Crowdfund Up founder John Quigley said the platform will allow all kinds of Australians to invest in property. He said they'll introduce investors to opportunities, and then when they pull together, they have increased buying power. Quigley says that he hopes the startup will provide a streamlined and transparent process with individuals able to invest from as little as $100. Well, thanks for joining me tonight to have your questions answered. Helping me to do just that tonight is Damien Collins from Momentum Wealth and Ben Kingsley from Empower Wealth. And if you have a question for any of us on the panel this evening, it's time to get to your phone to call us on 1300 30 34 35 or email your question to me now at property@skynews.com.au. Welcome to the program. Let's get underway, and welcome to you both.
Hi, Margaret. G'day, Margaret.
Damien, 0% interest rate. I haven't actually seen indicators for that.
No, you'd have to be looking at a pretty pessimistic outlook on the economy over the next couple of years to get to that. And look, here we're different slowdown. The mining sector's come off, but other industries and the financial sector are doing pretty well, particularly in Sydney. So I just can't see that happening.
Non-mining capitals are actually showing very strong economies, Ben. And I guess we've had quite a lot of these US analysts making these wild predictions. You know, I'm doing, as a lot of people know, doing my roadshow this week and last week, and I went back to 2010 and had a look at what some of the US analysts predicted in 2010, and then we had a look to see how they turned out, and they all turned out pretty badly.
It's headline grabbing, isn't it, Margaret? I mean, let's face it, they're sort of talking zero interest rates. If we're getting to zero interest rates, we're basically getting to a position where we're in all sorts of trouble, aren't we? I mean, you know, the economy would be faltering. There'd be a lot of problems around mortgage stress. It wouldn't be a pretty picture for asset values, not only property values, but right across the board. Yeah,
well, think about it for a moment, Damien. When the US got to their 0%, it was in the face of 35% of their mortgages really going into default, a big subprime market, and the complete bottom falling out of the real estate industry as a precursor to getting to 0%. They didn't go to 0% and then have the bottom fall out. They started to have the bottom fall out and then they went to 0%. We don't have any of those indicators here.
No, exactly. And as you said, the property market collapsed. The unemployment rate went up substantially, up towards 10%.
And 16% in California alone.
Some places as well. So there's nothing out there that suggests Australia's going to be anything like that. We think we've got different sectors of the market are doing better. Mining states are having a bit of a downturn, others are coming along picking up. Construction's good. I think it's just, as Ben said, headline grabbing, and he's got the headlines.
Yeah. Ben, I think if we had a 0% interest rate, it's just one of those things that the market at the moment is just too buoyant, and the economies of many of our states are very strong and robust. Really, if people understand the way our Reserve Bank works, they use interest rates to manage that economy, and if anything at the moment, with a robust economy, if our GDP starts to get too high, they'll actually increase rates rather than drop them.
They will, and so basically what happens with monetary policy Government looks after fiscal policy and the RBA looks after monetary policy. Now, when we're sort of talking about that, it's a pretty blunt lever, and Glenn Stevens has come out and said, with such a lever, there's only so much he can do. He's looking and guiding government at the moment with the May budget coming up to actually look for some type of more stimulus in infrastructure and spending, because he needs that, because at the end of the day there's only so much that his instrument can do in terms of stimulating the economy. There's very much a push for business to get back in, low money, start spending, start investing in your companies. I mean, equities are at really high levels. So you're going to see investors asking, well, where's the next lot of push going to come in terms of equity values? Now, that flows onto the economy in terms of businesses can only have so much cost cutting. They've got to go out there and actually do something and build some business and get the economy moving. Absolutely.
And the economy is actually looking pretty good, as you said, Damien. The non-mining capitals are looking strong at the moment. We do expect a bit of a fall-off in the mining capitals, but that's largely because many of the construction phases of some of the big mining projects came to a completion in 2014, 2015, and we're looking at 2018 before the operational phase of some of those mines actually commences again. Yes. It's going to leave that little black hole for maybe Darwin and Perth for that little while, but it isn't an endless black hole, and there is an expectation of a return to better times in the mining industry, probably from 2018 on. And
look, the forecasts still are around the world that long-term China and India coming up further after that. There is a huge demand for resources. It's still there. It just so happens that we've oversupplied with too many projects on the go. You'll find, particularly gas in WA, Queensland, Northern Territory, there's all the forecasts as people getting rid of coal. There's a lot of growth opportunities. But, yeah, in the next short term, you're not going to see as much growth in those locations.
Absolutely. Look, let's quickly go to our second story tonight. And, Ben, crowdfunding for property. I'm not sure about that.
New idea. I mean, crowdfunding's been around a little while. It's been heavily adopted in the US and so forth. The question for me, and I don't know the development, so I don't want to, sort of turn it down, but what I'd be thinking is, what do I need to go to the market to raise funds at that level? I mean, wouldn't my inner circle, like if the development was to stack up, my first question as an investor is, well, wouldn't there be people lining up to jump on the development? So I'd be doing my due diligence in a very strong way before I would decide, this is my $100 is going to go here and my $5,000 is going to go there.
Damien, I guess the idea behind it is to allow people with small amounts of money to get into property, but we already have plenty of vehicles for that. We have property syndicates, we have property trusts, listed and unlisted, and, there's quite a lot of stuff already moving in that space. Yes. I'm just not sure that crowdfunding really adds a significantly better benefit. I kind of read about it and I couldn't see the increased benefit in it. I must admit that I'm a bit confused. The article I read didn't have a lot to say about what the structure is going to look like under crowdfunding, whether they'd be buying units in a trust or whether they'd be actually having, everyone's name on the title and having 500 names on a single title, or how that was going to work. But surely there's not really room for another form there.
I had a bit of a look at it last week when it came out, and they're done through regulated products, so they are regulated products.
Okay. So they'll be unit trusts or whatever?
They'll be unit trusts, so you won't be on the title.
Yeah.
I guess it's one of those things, development has typically been for the domain of the higher net worth person, the higher income person, and I guess it gives other people access and opportunity, but the thing is development carries risk, and there's plenty of development projects that make a lot of money, and there's plenty that go out of business.
There's a lot really, isn't there? And I think, I don't know the exact figures, one of you might know it, but it's like some 20 or 30% of all development projects come across some kind of problem, and I know that I've seen a significant number actually where the developer goes into liquidation before it's completed, and the liquidator completes it and sells it, or sells it all in one line, or does whatever. There is a significant portion that actually do that, isn't there? And when we say significant, it's like if a normal person building a house had a 1% failure rate, there's, it's probably 30 times that with the big development.
Look, and development can provide huge returns, but there is a lot of risk, and there's so many things: builder risk, financing risk, pre-sale risk, a whole raft of things. And I guess anyone going to one of those products just needs to know that if they could potentially lose all their money.
Absolutely. Well, look, let's go to the phones now, and Peter from Adelaide. You're welcome to the program tonight, Peter.
Thank you.
What can we do for you?
I've got a self-managed super fund, and I'm wanting to invest about $700,000 in the Queensland, Brisbane, preferably, property market. But I was thinking of the relative merit of buying in Paddington, where you can buy one house for about $750,000, or to go further out in the Ipswich and buy 2 for the same price.
Or maybe even 3 if you're out around the Loganshire. It is a really good question and people often grapple with it. Ben, what's your prognosis at this point in time? We're really talking middle ring in Paddington. I guess in comparison to Sydney, Melbourne, it's inner ring.
It's still inner. Great question, Peter. I mean, the big thing for me is, if you were coming to see me as an advisor, that 700,000 point is actually going to get you a freestanding asset closer to town. So Paddington is one of the areas that I'd be saying is well worth running the ruler over. You've got to understand, what is it you're trying to achieve from this? When you go into a house, a freestanding house, your yields may be lower. Margaret was talking about other areas which can potentially attract a higher yield and less cost to obviously support that investment. I think the capital growth in the Paddington area, given the scarcity of housing, I mean, I'd certainly be worried more around units in that particular market, but the scarcity of housing puts you in a good long-term position to see some good sizable growth going through that area, because it passes a lifestyle test, it's got convenience, it's got proximity, and the other important thing about Paddington, it has status. And what I mean by status is that people actually want to live there. And when you drop the name like Paddington, people say, well, that's a cool area and a nice area to live. So in terms of attracting the type of tenant you're going to get obviously that upward professional, that executive type that's going to look at that. But again, on the flip side is the yield story. So if you're going to look at wanting to get that yield and you need to get that property delivering you that income sooner, then diversifying into several properties could be an option.
And what do you think, Damien?
Well, Peter, look, as Ben said, Paddington's certainly a prestigious or relatively prestigious area, but the difficulty with that is a lot of people know that already. I like to buy in areas that people don't quite know yet are going to become prestigious, and you get that extra growth out of the market. So we're in Brisbane, we're going a bit further out, still around that 10-kilometre radius, Chermside, where they've got some strategic things happening. So you're going to get a house, we've been buying them there for certainly around 500 and sometimes even less. So look, again, you've got to decide, is it yield that you focus on, because the yield will be a lot bit, certainly less in Paddington, and maybe it's a split of 2. You might get something at 450 and maybe something else at 250 is going to be hard to get much for that. But
still plenty out there.
Yeah.
Still plenty out there. Hey, look, Peter, I just want to add a couple of things to that. First of all, Brisbane's already seen a bit of growth, and most of it has been in that inner ring. If we keep the units out of it, because there's a definite oversupply, there's $2 billion worth of apartments coming onto the market in Brisbane in the coming 2 to 3 years, or about to be delivered. If we put that out of the picture for a moment, there has actually been some significant growth in that inner ring already. My only concern with buying there now is that while it will be a nice solid asset that will continue to grow in the future, it's already had a fairly good amount of growth, and you might have to wait a little bit longer to get some more. Whereas there are other parts of Brisbane that haven't had it yet, and if you want it sooner rather than later, being in your self-managed superannuation fund, it just depends on how long till you need to have that vested so that you can start taking that out or send it into pension phase. I think there's a couple of other things to be said as well, and that is that if you do split it up, whether it be a 450-250 split like Damien says, and certainly there's plenty of property in the 250 market up around Deception Bay and those areas that are 20 minutes from the airport, coastal, and still got a lot of oomph in them as well as good 6% yields, you then have your money spread across 2 assets. The risk of vacancy gets reduced because it's unlikely you'll have both vacant at the same time, whereas one asset, if it's vacant, your whole asset isn't earning an income. You've got 2, you can possibly buy in 2 different areas that are subject to 2 different kinds of growth drivers as well. So one might do well while the other stagnates, and then vice versa later on down the track. And I think you also get that opportunity to just get ahead and still get a good cash flow. The 700,000, you didn't say how that's split up. It could be cash in your self-managed superannuation fund, in which case you can leverage a little bit with some non-recourse borrowing. If that's the case, then maybe you can split it up into 4 lots of 300,000 or 3 lots of 400,000, and maybe buy 3 and sort of split it up all around the place. The good news is, the bottom line is, in Brisbane, everywhere pretty much is going to do quite well as long as you stay somewhere in the suburbs. And the further out you go, the better the yield, but it doesn't necessarily mean that you're going to forego that much growth. There's some really good growth coming up all over that market. Well, thanks for tuning in tonight. As usual, we're giving a prize of one of my books for the question of the week. Now, this week, that book will be How to Achieve Property Success, the complete guide to investing in property, whatever your current experience. Call us now on 1300 30 34 35 or email property@skynews.com.au with the question, and make sure you watch at the end of the show to find out if you have the question that we choose. We're off for a few important messages. Don't go away. When we come back, we'll take some more calls and answer your questions. Welcome back to Monday Night, Your Money, Your Call. If you've just tuned in, tonight I'm joined by Damien Collins from Momentum Wealth and Ben Kingsley from Empower Wealth. So there's wealth everywhere tonight, and we're here to make sure that you get the answers that you're looking for. If you have a question, grab the phone and call us now on 1300 30 34 35, or of course you can email property@skynews.com.au. Remember, the caller or emailer of the week will receive my book, How to Achieve Property Success. Now, Kezzy has a good question about properties under contract, and she asks, I'm currently searching for a property and I often come across real estate sales agents advising me that a contract on a house that I may be interested in has fallen through due to finance. How can I be sure that it wasn't due to a bad build and pest without having to fork out money every time for a report, only to find out the real estate probably knew it in the first place? Tricky, isn't it? Because really, it is. They will grab that. They're not all like this, but they will grab those excuses. And there's different laws in every state as well, so it can be a convenient excuse. Yeah,
it definitely can be. Look, Kezzy, I guess you're just going to have to bite the bullet and spend the money in the building and pest as much as you don't want to. Look, it could be quite legitimate that they do fall over subject to finance. Often, one concern might be that if the valuation didn't come up, that certainly might be a reason to be concerned. But it could well be that sometimes people put offers in on properties, haven't even gone and talked to their broker or their bank about what they're trying to achieve. So, look, I don't think there's much you can do. If the agent's not going to give you that information, I wouldn't have thought, so you're just going to have to bite the bullet. But just make sure you've got good contract clauses that mean if you're not satisfied with the building or pest inspection in any manner, you can walk away from that property.
Ben, the Canberrans have the right idea in insisting that all vendors actually get the pest in building and provide it to anyone who wants to buy it. Wouldn't it be good if every state brought that in?
Well, it'd be fantastic. There's, you think about it logically, it's a high-cost transaction, so, the small price you pay, a couple of $100 to actually get
$450
that,
at the most.
Yeah. Look, I come back to the point, they shouldn't be able to lie like that. If it is fallen over because of build, you've got to just keep asking the right questions of the agent. Are you telling me that this definitely fell over through a bad finance contract? Just keep prying, because you'll get the answer out of them. I mean, they shouldn't blatantly lie like that. I mean, it's against the law. They have regulation and obligations.
Kezzy, I have a little strategy for you to use to make sure it doesn't happen. Everything that you speak to an agent about, speak to them about it only in an email, and say in the email, look, what I need you to do is put in writing for me why it's fallen over, so that I have a written record of that reason. That's all you need to say. Now, some real estate agents, and please, I don't mean all real estate agents, because there are some fabulous ones out there and you know who you are, but some real estate agents, and you also know who you are, will lie to you, but very few will lie in writing, because they know they've created a record that you can keep forever. And if you do that, then I think you're going to start getting more the kind of answers that you really need. I never, ever, ever deal with real estate agents verbally. Even if they call me, I say to them, look, I want to talk to you, but I'm going to put it in an email and send it to you. Or if they tell me something on the phone, I say, could you just confirm that in an email to me, please? That'll sort them out for you. Julie from Sydney, how are you going?
Good, thanks. How are you?
Good. Now, you're a bit worried about the market crashing.
I am. I'm just wanting to ask you a question about timing to sell, and I'm just am worried about a market downturn later in the year. So I'm thinking of selling a property. I'm worried that a significant market downturn later in the year might affect the property value, so I'm thinking of selling now to get the best price. Or should I risk that maybe that downturn won't happen, but then I may have to wait another year or more for recovery and therefore get the price that I'm seeking?
And where is this property, Julie?
The one I'm thinking of is in Girraween, and I'd like to maybe help fund another property I've bought, a rural property down on the south coast.
Okay. All right, a couple of things here. Girraween is in a very hot market. The whole Blacktown area has been hot, 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 and look, probably at its peak. But if Julie's just funding the proceeds into another property, then it almost becomes that kind of nil-sum game, doesn't it, where what you sort of lose there, you'll gain on the other side, Damien?
I think so, Julie. Look, it's always one of those things that for investors trying to time the market in and out, they often find that, particularly when you look at your transaction costs, if you sell, you've got to have a selling agent, you may have capital gains. You're losing a lot of cash there in that transaction, and often most investors don't get the timing right. So if you're trying to time to get out, to get back in, then I would say, look, you might want to hold on to it. I think certainly that area is going to have a period of a flat time. You know, again, if you are looking to sell it, generally you're going to sell it one way or the other, then maybe you want to think about doing it sooner, because Sydney's had a pretty good run. It's going to come to an end. We just don't know exactly the day.
Ben, the last 10 years, if you go back from today, Sydney has grown by 3.6% per annum, which is quite average. In fact, every capital city tends to grow by that amount when you measure it over time. If you think about Sydney now, Julie's worried about a year or two for the recovery. I think it'll be longer.
Look, the challenge with any type of peaking in the market, Julie, is, and we know this statistically in terms of what actually happens. So there is a lot of people like you who hold off. And by holding off, they're trying to time that. And when they see the peak, we don't know it's the peak until it's over. And then we actually do see a rush of property that comes on the market. So I'm with Damien. If you really think you definitely need to sell and go and get some independent advice, then now is a good time to be looking at talking to your local agents, getting an understanding of how they're going to market the property and take it forward. Because if you do leave it too late, again, the peak is only known once we come off that, and we normally see a glut of properties for those people who are trying to get into the market. So maybe now's the time.
Some good advice there for you, Julie, all up. And Fred from Sydney, how can we help you, Fred? Hello, Fred.
Good evening. Good evening. How are you? Good evening, panel.
We're well. What can we do for you, Fred?
Over the weekend I bought a terrace out in Annandale, and I'm not in the Sydney market, but last week I decided to buy. So I just want to renovate and hopefully make a profit. Do you think it would be the right thing to do is to keep it for a year, or just try and get it ready and just sell it right away?
Well, goodness me, talk about asking for advice after you've already done the deed. We've only got a very short amount of time. Ben, what can you tell very quickly to Fred?
Fred, talk to your local agents, get an understanding of what type of renovation you're going to be able to do, talk about potential sale prices in that area into realising that gain. Focus on $1 for $2 return if you're going to spend any money on an investment property in that particular area, or take a long-term view. And if you do, you know, a lot of people who do sell properties wish that they never did when they look back in hindsight. So go and seek some independent advice and get some right answers.
And when you go to that real estate agent, make sure you go to one who also has a qualification in valuing. They don't all have them, but he will probably give you the best advice about how the local market's going and whether or not you should sell now or hang on. Well, this is Your Money, Your Call, and we've been answering viewer questions tonight, but it is time to take a quick break. It won't take long, so stay tuned, and perhaps even call us now on 1330 3435 or email us on property@skynews.com.au. We will be right back. Welcome back and thanks for watching. I'm Margaret Lomas, and with me tonight is Damien Collins from Momentum Wealth and Ben Kingsley from Empower Wealth. Now keep those questions coming. You can do so by calling us on 1330 3435 or emailing us on property@skynews.com.au. Now remember, if we do answer your question tonight, you could be chosen to receive a copy of my book, How to Achieve Property Success. Now before we go to the phones again, here's some news about my national roadshow, which continues this week in Melbourne and Sydney. Now each year I travel to the major capital cities and I present my market update and a new list of areas to watch. This week I'll be in Melbourne, tomorrow night, the 24th of March, at the Ridges on Swanston Street, and in Sydney on Wednesday night, the 25th of March, at the Northside Convention Centre in Crow's Nest. We'll also live stream that event for anyone who can't get to a venue but would like to log in online. Well, it's a great night and it's not too late to book your place. Just go to my website, destiny.com.au, and go to the events page for tickets and more information. George from Melbourne, welcome to the program, George.
Oh, thanks for taking my call. I had a rental property that I sold a month ago. I'd like to know if it's a it possible to put $35,000 into my superannuation to minimise the capital gain from the sale of the property?
Wish you could, don't you, Damien? Because I'd be doing a lot of that.
Absolutely. George, obviously we don't know your employment status. If you're self-employed or you work for a company, you can certainly salary sacrifice that way, but there are now caps on what you can actually put into super and get a tax deduction for, and they're not very significant. Unless you're close to retirement and don't have much super, then you can get a little bit more. So there's no magic trick. As Margaret said, we would all figured it out by now and be telling everyone about it. So look, I know people hate paying tax and no one likes it, but capital gain rates, it's half your marginal rate, so it may not be that significant anyway. So.
Unfortunately, we can't roll over gains into super and protect them or quarantine them. Ben.
George, it all comes down to the actual name that you had on the title of the property. So if it's in your own name, then that's income. Is it pre-taxable income? Not sure. You'd need to talk to your financial advisor about that, whether you can actually get that out. But my gut is telling me I don't think so.
You're not going to be able to roll your gains over into super, I'm afraid. Different if you bought it in super in the first place, but it's not going to happen. The only thing you can really do with super, where property is concerned, is if you have business real property, you can transfer the property into super without paying any kind of taxes and things like that. You can make that transfer. It's legal to go from you to you in super. You can't even do that with your own property. So I guess the good lesson for you is in the future, before you even buy or sell, talk to someone who knows these things so that you can get your structures right first. There's a lot of tax savings to be had, but you have to know how to get them right on the way in, not think about them after you've already done the deed and come out. Paul from Melbourne. You're also from Melbourne. A lot of Melbourne people tonight, and I've got one on the panel as well. What can we do for you, Paul?
Good evening, Margaret. The first issue is that you've been making comments about the Melbourne market with apartments and units, and you are very, very wisely and correctly picking that Melbourne is abundant with so many units and apartments in supply, and the prices seem to be all over the place at the moment, depending on locations and things like that. The next issue, as part of that question, is there any part of Melbourne that yourself and the panel might say might be an opportunity that is under the radar of the normal offerings that seem to be happening?
Well, you know, Paul, I have a couple, but you probably need to come along tomorrow night for me to reveal them to you. I might let one or two go tonight, but let's go first of all to Ben. Ben, you and I discussed the apartment oversupply. It's massive numbers.
It is, and it's in concentrated areas, Paul. So the big thing and the message here is, where are the areas in Melbourne where you're seeing high density and medium density approvals taking place? So you've got the Docklands, you've got South Bank, you've got the Toorak area where there's a lot of pressure in terms of seeing these medium and high density developments trying to get approval through VCAT. You've got Flagstaff Gardens area, the top end of near the Victoria markets there, we're going to see an oversupply. So it's very, very difficult in terms of that. So my advice is, if you're looking in the Melbourne market, look for areas where there's low density, and if you're looking at units, look for units in small blocks in residential streets. They're the ones who still maintain their scarcity, and you'll see over the longer period of time they'll give you the best returns.
Is there anywhere you're liking in Melbourne at the moment, Damien?
Margaret, I was just discussing with Ben off air that yeah, the inner east in Melbourne particularly is overheated and overcooked, and that's the prices just getting ridiculous. 80+% auction clearance rates, and certainly an overheated market. So, look, if I was choosing a city to invest in from this point right now, I wouldn't be choosing Melbourne. I think Melbourne's not as hot as Sydney, but certainly Melbourne's a little bit overcooked. But, look, you might want to, again, look at some of those areas. Melbourne long-term is still great fundamentals, a lot of population growth, and so I'd be looking at some of the further out areas, but with a good infrastructure, maybe out Ringwood, out that sort of way, or down on the peninsula side, maybe he's getting as far down towards Frankston. That, as long as they've got the infrastructure, the roads and the train access, that's, if you're going to look in Melbourne, that's where I'd be looking.
I'm just going to throw this out there, at the risk of getting letters and mail and hate mail and things like that. I'm liking Sunshine, Keilor Park, and I really like Cranbourne from the perspective of getting a pretty good yield and also some future growth. And if you think about where Cranbourne sits, it sits in behind some suburbs that are actually significantly greater in purchase price, 100 and 120,000 greater, with significantly lower yields. So there's a couple, Paul. I've got more than that on my hotspot list, but you have to come along to the Ridges on Swanston tomorrow night, and I will tell you all about them when you do so. Well, Brendan is keen to get started and has this question for us. He says, I would like to eventually build a property portfolio to build a source of income to fund my retirement. And I'm 28 years old, so well done, Brendan. And I don't own any properties yet, but I have saved enough for a deposit. Would you recommend I buy an investment property first or buy a house to live in first and then invest later down the track? I love this question because there's a whole lot of stuff around it, and it's got to do with a whole bunch of things: personal choice, lifestyle, job, family, yeah, your personal goals. What do you think, Damien?
Well, Brendan, I would say, as Margaret said, there's a whole lot of things to consider, but I don't think it's something you need to over-analyse and over-agonise about because, you know, obviously you'll make the right choice, you get the right advice from somebody, but you'll make that right choice that suits you. We've got plenty of clients who have 3, 4, 5 investment properties who don't own a home, and they're perfectly happy with that. They rent an area they want to live in, might be a unit or an apartment. It's not a great investment, but they get a great lifestyle, and they buy good quality investments. So sort of go and seek advice from a QPIA, someone who knows what they're talking about, but don't over-agonise over it. As long as you get into the market and getting a good property, it certainly may mean that that investment property is better than buying a home.
I guess the great Australian dream was foisted onto us by our forebears whose own parents came through the Depression. They didn't have a home of their own. They fought to get it for their kids. Their kids got it and grabbed hold of it, and all they did in their lifetime was paid off the house and then waited for the gold watch when they retired. And the pension was okay then. You know, you retired at 65 and you were probably dead by 68. The pension was okay for 3 years. But everything's changed now. We're looking at retiring early. We probably live 30 years into retirement, and that pension is no longer cutting it. You know, it's good to hear of young people wanting to really start to get on the property ladder, but it doesn't always have to be through their own home, Ben.
No, it doesn't, Margaret. And for Brendan, that's exactly right. You've got to understand what's happening in your life over the course of the next 5, maybe 10 years. And if you're looking to settle down, partner up and those types of things, having that uncertainty about what your relationships into the future are going to hold you says that an investment property right now might give you some of that flexibility as opposed to launching into your own principal home. Because the reality is when you do, find that future life partner, you're going to be looking at getting a sizable home, something that can accommodate children potentially. So it's all those types of things that you need to start thinking about. The good news for you is at 28, you're making those sort of decisions, or you're starting to think about those decisions now. Nothing more frustrating than potentially talking to someone who's coming in to see you for the first time and they're in their mid-50s and they're now starting to think about investing in property. So having that time on your side means that you can, obviously don't procrastinate, you're ready to make some decisions. Go and speak to someone, get some professional advice, and they can plan out what the next move for you is.
Yeah, and look, I guess one of the good things for you, Brendan, is that it's okay to get on the property ladder first. There's a whole pile of benefits from that. And in this day and age, even with interest rates so low, it's very often cheaper to rent where you want to live. And while you're then getting a tenant and a taxman to pay off a property for you, you're saving another deposit with the excess money you've got left over from paying a lower rent than you'd pay on a mortgage repayment, and you're saving toward that next property, and it comes sooner because the property you bought goes up, you save a bit of a deposit, and together you're creating another deposit for the next property. As long as you don't live in a property for a continuous period of more than 6 months, you also retain any first homeowners grant that there might be for a future own home purchase. So a lot of people worry that they're going to give up the first homeowners grant by investing in property first, but as long as you don't live there, that won't happen. So there's only good news for renting. If you don't really mind the potential that you could get kicked out of a property that a landlord wants back or sells to an owner-occupier, then there's nothing wrong with starting out that way. Certainly a lot of my kids have, and a lot of people that I know have, and it's turned out very well for them. Now, Dan has an email and he says, I'm a young professional looking to purchase my first property. However, the opportunity has arisen to purchase my parents' house in Campbelltown for the remaining amount of their current mortgage of just over $100,000. The house is valued at approximately $400,000. It seems like a win-win for both of us. They'll have no debt and have more money in their pocket, and I'll have my first house. Are there any issues regarding doing this that I'm not seeing? Well, I think it's fabulous for Dan. I don't know where the win is for Mum and Dad.
Where's the win for Mum and Dad?
Very generous.
They're very generous. It's like, I guess it's a pre-death inheritance in a lot of ways.
It certainly is. Well, Dan, in any state around Australia, you'll pay stamp duty or transfer duty at the deemed market rate. So even if they transfer it to you at 100, you're going to have to pay the full rack rate of stamp duty. Look, obviously, we don't know about your parents' financial circumstances and other things, but look, getting it 100 for 100,000 when it's worth 400, I mean, that's just clearly a no-brainer. Obviously, that's a family situation you need to look at. But, you know, yeah, when you're that far in the market, I'd be buying it tomorrow.
Yeah, me too. In fact, if they don't want it, Dan,
give it to us.
I'd be happy to take it off their hands for them for that. I'd pay 150, actually. Campbelltown has some good fundamentals, Ben.
It has. It's had a really good run, and that would be my only thing in terms of, you know, if you're buying for the long term, you know, set and forget. That's good. So I do expect it to come off.
Yeah.
I do expect it to come off its highs.
But if you're only paying 100,000 for it, it doesn't matter.
Your yield's probably, you know, 22% or something like that.
Yeah, exactly. Okay, so I'm guessing as well, Dan, that Mum and Dad aren't going to pay any rent to you. So for you, the only thing to consider is the fact that you're paying 100,000 out and you're not going to see an income on that. And I don't know your financial circumstances, but you probably need to just check first of all whether or not the bank is happy with that, and that would require you to service or cover off the debt just from your own income without seeing any income from it. I'm assuming as a professional person that you should be able to do that. There's going to be some there's some problems that people sort of aren't really thinking through with these. You're going to give up your tax deductions on that. If your parents live in there and they don't pay you any rent, even if they pay you a small amount of rent, if it isn't market rent, the tax office has the right to say to you, your deductions are limited to whatever percentage of rent they're paying, that's the percentage of deductions you'll get. So if they're paying you 20% of market rent, the tax office may only allow you 20% of the deductions. So there's a couple of issues around that. I'm not sure whether you're going to live with them, but if you are, then you've got to think about the fact that you might not want to do that long term. And if you are married or you're not married yet, there could be some issues that arise if you go into a relationship. So do urge you to just think about what could go wrong. I mean, it sounds like a no-brainer, and it probably is a no-brainer, but these things are best dealt with on the way in, rather than you suddenly realising halfway through it that you've got issues that you haven't dealt with. Sit down with your parents and discuss every downside you can possibly think of, write them down and agree going in on what your strategy will be for dealing with it if and when it arises. That way you've got it in writing, you can agree on it beforehand, people won't get hot under the collar. I'm just a little bit worried about your parents though, and I do hope they have a good retirement plan of their own in place, because you might not want to have them living there forever. The time might come where you do meet someone, it's time for you to set up life together. You need to pull out the equity out of that property in order to go into one of your own with your new partner. You might not want to raise a big debt and you've got all this equity in there that could give you a lower debt. How are you going to feel about kicking your parents out at that stage? That's just one of the problems that I think, but happy to talk any more of them through with you at any time. Well, in our next question, Julie is worried about her property dating. And she doesn't mean dating another property. And she says, my husband and I own a townhouse which is tenanted in a very good location in Greensborough, an outer north suburb of Melbourne. The property worries me that it has the potential to date a lot quicker than other properties because of the look of the property. Should we sell it while it's in vogue or risk that it may devalue because of the style? Never been asked this question before and never really been in the position where there's a big devaluation on demand property because it looks a bit older.
I think it's, look, if there was a lot of that stock and there was maybe some other properties, newer ones coming on the market that might make it look that particular way, then it's a slim possibility. I guess there's certainly in some areas in some suburbs around Australia that we don't buy particular types of properties because there's a lot of that particular era and they all look pretty, start to look pretty average. But look, again, it's one of those things that once you've got the property, if you've made the right decision in the first place and you've done all that, it's still good growth area, you probably generally wouldn't sell it because, again, you've got capital gains, agent fees, all the other costs, and to get back into somewhere else, you might drop 20-30% of the property's value. So, again, I think you might be just overanalyzing it, and my recommendation, without knowing obviously the property, is that it want to be a really compelling reason to want to sell that property.
And in reality, there's a fair amount of refreshing you can do on a property, isn't there, Ben, at a low cost to bring a property a little more into vogue? Yeah,
and let's be honest, we don't want to be spending a lot. This thing is about getting an income. So I would also argue that 80% of your return comes from the area you're buying and only 20% comes from the actual property you hold.
Yeah.
So you know, these are gooses that lay golden eggs, and that's the income that we're going to get. The land content that you're owning is going to drive that, and so over time you're going to be able to live off that passive income. So I always say to my clients, just keep it in a good lettable order. Clean and tidy, reliable and durable. That's all you're looking for to be able to pass on that ongoing income. I wouldn't be selling just because you think it's a little bit dated in terms of its style, because of the costing, and as Damien said, getting in and getting out of the property. You're going to lose money on that. It's very expensive to enter property and exit property. So for me, it's always a hold unless there's extenuating circumstances.
I agree with the panel, and I don't really have anything to add, Julie. I wouldn't worry about it devaluing in style, because also remember that where you buy it, all the other houses around it are probably the same. Unless you have the only house in the street and no one's built yet, then everything is going to look the same, and in 10 years' time they'll all be 10 years older. And so you'll have a house that looks like all the others in the street. I wouldn't worry too much about that one. Well, we're getting closer to the end of the show tonight, and we need to take one more quick break, but you might still be able to get your question answered if you hurry to the phone, and then you will be in the running to receive a copy of my book. Call now on 1300 30 34 35 or email us on property@skynews.com.au. Welcome back. It's been a great night with Damien Collins from Momentum Wealth and Ben Kingsley from Empower Wealth answering your calls. Now, our lines are now closed, but during the week you can email your questions to property@skynews.com.au, and we just have time for these last callers and emailers. Kathy from Sydney, how are you going?
I'm good, Margaret. How are you?
Good.
I'm just ringing. I've got a property, a 5-acre property at Bringelly, and all the infrastructure what's happening with Badgerys Creek Airport. The return is not so great with the rental property because it is on 5 acres. Am I best off selling that, getting money for it, and going and investing in properties all around Sydney where I would get a lot more return, or am I crazy and just hold on to it and then wait for the future of it becoming a lot of money?
Yeah, look, first of all, I don't necessarily recommend you sell Bringelly to go all around Sydney. I mean, we've made it fairly clear already that Sydney's really come to the very end. It's going to dwindle down. I personally feel anyone who buys in Sydney in the coming year, when the correction happens, they will lose 10% off their buy-in price. But whether or not you should sell Bringelly and then go and buy properties everywhere else is another thing.
Potentially, Kathy. I guess I'd be looking at, obviously Badgerys Creek is looking like it's going to come on board eventually and finally after a long, long time. Will your property be rezoned? So 5 acres, which may not be worth a huge amount now, in a rezoned area, could be worth something substantial. So I'd be doing a bit more forward planning, seeing what the likelihood of some rezoning might be on that property before I made any decisions.
Agree entirely. Ben, a question though on the growth side, say it doesn't get rezoned. Think about Tullamarine for a moment. The airport development around there didn't really skyrocket prices out there. Everyone's getting all caught up on this whole Badgerys Creek thing and saying, oh, it's going to make properties around there skyrocket, but it actually doesn't necessarily happen. And even Mascot, you know, for years was a very, very low socioeconomic area without very much growth at all. And in the end, it took off not because it was near an airport, but because it was an affordable part of Sydney, still close to Sydney, and it got pulled up by that. I don't know that Badgerys Creek is going to really impact back on property, at least in the next 10 years.
No, it's an interesting one because I'd be looking at, again, the zoning and the flight path layouts. If you're under the flight path, then the land is not going to be worth a lot at all. But if there is potential for subdivision, there's no doubt that that subdivision will absolutely outperform. So even if you tried to buy properties everywhere else, if you can get that 5 acres into, you know, 22 lots or something like that, that's a massive payday. So it's all about going to speak to a professional town planner, talking to council, getting an understanding, and sort of making decisions. It's all about informed decisions.
Now, having said all of that, Kathy, becoming a developer and subdividing 5 acres into 22 blocks is a massive thing to take on, and it is very costly. It usually pays off, but it is a long road, an expensive road, and one that will probably cost you far more than you ever thought it would. So it might be something that you don't want to do. However, from my perspective, I think for you it might even be one of those things where if there's a chance that it can be subdivided in the future, you've got an opportunity to sell it to someone who's prepared to do all of that. So you don't necessarily subdivide yourself, but it'll be worth more because the developer will want that from you. Give council a call, have a frank discussion with them. If they can tell you whether there's absolutely no plans to ever change that, or if it's on their radar, at least you'll know at that point in time. Oliver from Sydney, how are you going, Oliver?
Good, thanks. How are you going?
Good. What can we do for you?
Look, I'm basically looking to buy my first property, but it will be an investment. I'm from Sydney and I'm looking to buy in Brisbane. I've kind of narrowed it down to the, I guess, outer ring, maybe 8 to 10 k's from the CBD. Looking at maybe Mitchelton, Stafford, Gaythorne, that kind of area, but I'm just wondering what your guys' opinion on it is and if I should be looking further out or if I guess the growth's already happened there already. Okay,
8 to 10 kilometres, really the middle ring in Brisbane rather than the outer ring. Ben, what would you say about that area?
Yeah, it's a great question, Oliver. In terms of, it's all about price point for me. I'd be looking at the suburbs that have got the higher median values and then buying the entry-level properties in those particular areas. In that sort of middle ring, you're going to do well if you've got a long-term view, and it's also a bit of a timing thing as well. So for me, I'd be focusing on the best area in terms of right street, high medians, but buying under that median so you get that property lift.
And in Brisbane, I'm picking the 10 to 15 kilometre ring as being the one that's going to go next because we have seen a fair bit of movement in the one you're talking about, which you've already pointed out, you've noticed yourself. So I'd be starting to push it out to 10 to 15. There's plenty of opportunities 15 to 30 out, but maybe for you, have a look in that 10 to 15 ring and see what you can find there. There's certainly a lot of good opportunities around the $400,000 to $450,000 range. Well, that wraps up this week's show. Next week, Michael Tees is in the chair and he is joined by Rich Harvey and Ian Rodriguez. So get those questions sent to me during the week and I'll make sure I pass them on. I'll be back the following week. Thank you to my guests this week, Damien Collins from Momentum Wealth and Ben Kingsley from Empower Wealth. They will both be back later on in the year. Thank you also to our callers. Now, the book prize this week, we have all chosen Brendan, 28 years old and ready to go with his first investment property. If you can now email me on yourmoneyyourcall@destiny.com.au, you can see that on your screen there. I will send you your book, How to Achieve Property Success. Now, you can also follow me on Twitter, Margaret Lomas AU, and if you visit YouTube and go to Channel Destiny, you can see all of my contacts there on that lovely graphic that's on your screen. You can go to Channel Destiny and watch some really great video. Now, make sure you type in Channel Destiny and make sure you subscribe when you're there so you know what's coming up. At the moment, my 20 questions are all being screened right there. Don't forget to grab your tickets to my roadshow event in Melbourne tomorrow night, the 24th, and Sydney and online on the 25th. Go to destiny.com.au now for more information. Thank you for being with us, and I will see you again next week.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.